Hey, everybody. Welcome to the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Sloane Ortel, who is the CIO and founder of Invest Vegan. Sloane, how you doing?
I am doing really well. Thanks so much for having me.
Of course. Thanks so much for coming on the show. And we're excited to get to know a bit more about you, a bit more about your company. So let's start with your journey. Tell us about the journey of your firm, of yourself as an investment advisor. Kind of talk to us about yourself.
Sure. So my recent favorite conspiracy theory is that I was actually made in a lab to do sustainable investment management. And like when I say that, so I was sort of born in New York City. Both my parents were professional investors. My mom was a sales trader actually at Salomon Brothers, which is kind of some folks will know from the book Liar's Poker. She then kind of like taught economics at a public school in New York, and my dad was also a professor. So like at home they had like a terrible marriage.
Yep.
So the safest thing to talk about was often finance, and like. So as a result, like my mom liked to joke that I learned the difference between debt and equity before I could ride a bike. Uh, it's like it's the kind of thing like if I look back on that, like I hope that I don't know. I'm grateful to them, but it's also a strange thing to be like, yes, that kid. I'm so proud of her. She really knows her bond math. Uh, but but yeah. So I sort of like when I started an investment firm, it was sort of a surprise to. I was probably the only person who was surprised that I was doing it. All of my friends were like, "Oh yeah, we knew you were going to do that at some point." What's unexpected about the firm and is kind of this like ethical flavor that it has. Where like, my initial experiences in finance, like my first job was 2007. I was at Oppenheimer. I was 19 years old, talking to clients, like, handling their tuition payment that they thought like was going to be liquid and then it wasn't. And so, like I kind of spent this early time straight in the engine room of finance and seeing just how much it didn't care about the clients involved.
Yeah.
And so that kind of set off this kind of career long, like, I don't know, hunt for some kind of morality within finance. That, was like kind of my next step was an immediate response to that.
And so a lot of people would see that and they may just be kind of pushed away from finance in general. What made you start your own firm and seek morality in the midst of what seems like such a dark space on the outside looking in?
That is such a phenomenal question that both you and my therapist have asked me. uh like because if you think it's extremely well framed, right? Like it's so okay, yeah, like you've seen a very misaligned, you've been inside of a slaughterhouse. Why did you stay inside of the slaughterhouse industry? uh Part of it is that like I'm one of those weirdos who would be doing this even if it wasn't a particularly lucrative career field. Like I was explaining it like with a friend. I was sort of talking about how I feel like I'm more of a jazz musician than anything else, where like, the people who I'm really, I talk to a lot about investment management and stuff like that. Like no one's like vastly wealthy. We're not driving Lambos or anything like that. We just care about delegated decision making and fiduciary duty. Anyway, I just have been drawn to the subject matter is the short answer. And I also got the chance to spend basically my undergraduate education working as a staff member at the CFA Institute. So like this was like I joined in 2010. And I stayed there until 2017, or wait, no, longer than that. I don't know my dates. But I was there and I had this really cool job where I basically was in charge of figuring out who was interesting in the CFA Institute membership and kind of reaching out to them and saying, hey, like, you want to talk to me about like what you're doing in fixed income portfolio management? You want to talk to me about what this ESG thing is? And like, basically that was just what I got to do for like a long time.
Yeah.
So that really is what kept me in finance, because I was one of the rare weirdos who like not only has that ethical what the heck is going on moment, but also has people to ask about it who know what's going on,
Yeah.
That's like massive privilege.
Yeah, I mean, it makes a lot of sense. And so it sounds like you've been kind of living and breathing finance from day one? Was there ever a point in your kind of journey, whether it be childhood or, growing up, that you were like, I'm kind of sick of this? Or has it just been, I love it, I want to be in it 24/7 all the time?
I had a couple of moments where I've been like, God, what the hell? Can't, like, what? Because it's not like, if you see finance the way that I see finance, like, it's not. I said it's more like a faith tradition than it is like a profession where, I sort of take the fiduciary duty extremely seriously, yada yada, and it kind of invades the core of who I am. Like it would have been a lot better from a work-life balance standpoint to just be like, yes, here's a job and I will find meaning in stamp or wine collecting or something like that. I do love skiing, but the fact of the matter is I always wind up in, the economic history part of the bookstore, or, just kind of hanging out in my spreadsheet where I keep all my like kind of cumulative notes. It's like, it's so freaking lame. Like literally, I'm a huge skier. It could be a powder day, and and I will still sometimes be like, well, I don't know. Like,
Yeah.
And by the way, I'm based in Utah and I'm 45 minutes away from Malta.
I gotcha.
So yeah. Anyway, the like. Yeah, I mean, we are who we are. I think that's just kind of like we got to kind of accept our strangeness at some basic level in order to get on with the work of just being alive.
And so you talked a little bit there about the economic history section, right? And kind of staying up to date, just being in the weeds. Mm-hmm. Where do you go to stay up to date on the market and be looking at current trends so that you can kind of talk back and forth with your clients, fulfill that fiduciary duty?
Great question. So, one of the first, big things I do is, just go, okay, well, if you want to talk to me about what happened in the market today, take a walk, bucko. We send out performance reports about once a year, and I want to be kind of openly hostile to the idea that we should be talking about performance or market developments every once in a while. We put out an article, what does a recession actually mean for you if you're a long-term investor, in which we show, statistically, if you were to make a buy-sell decision on the basis of a recession was announced by Enber, you would almost certainly be selling at the perfect time to buy. So our approach will be, if there's an underlying concern that can be thought about from a statistical standpoint, we'll try and take our clients through that. But the emergent issues that we come up with day to day, for instance, we do all of our own ethical screening in-house, which if you think about it, if you have an ethical, kind of basis as simple as ours, does this kill shit? Where does shit die? And this is, can I say shit here? Is this a family podcast?
No, you're all good. You're all good.
Sorry about that. My mommy was a sales trader. What can I say? Read Liar's Poker if you want to find out who taught me how to swear. But but part of it is just kind of not taking the posture that we need to respond to every other thing. The other is staying in touch with other people who are kind of driving the industry forward a little bit. I have my own podcast, the Free Money Podcast, which I host with my friend Ashby, who runs the Stanford Center for Long-Term Investing, Stanford University. Very super sharp person, super good friend. And we just sort of, bring in people who are interesting. So for instance, there's this research shop called Carbon Tracker, which, kind of publishes sell side quality research on, all sorts of climate change stuff, right? So if you're thinking about how does climate change affect ExxonMobil, they actually have free street quality coverage on that question. Really cool. So one of the things that they are associated with is the thesis that diversified investors face a stranded asset problem at the moment. What's a stranded asset? It's what happens when we transition away from fossil fuels, but you're left investing in Exxon.
Yep.
Right. So, the trillions of dollars of fossil fuel reserves that live on Exxon's balance sheet, that live on Chevron's balance sheet or something like that, have an economic, they're load bearing in the economy.
Yeah. Yeah.
And so as investors, it's incumbent on us not just to kind of go and say, okay, is climate change important? But to localize the impact. So, we're bringing this guy, Mark, on who founded that. And like, so one tip is, kind of however you can create the privilege to ask questions of people you find interesting. That's like one of my big habits that I've kind of ingrained, and I use that big time to stay current. Which is important because now like Twitter is a much less useful source of information. Uh,
Yeah. Yeah.
and so like there are a couple of newsletters that I pay attention to, like Tom Brackey, who the is just a brilliant analyst who writes the Research Puzzle and the Investment Ecosystem. Is somebody who comes to mind. But we actually have a process, like our intranet has hundreds of links to individual blogs, news sites, trades, regional business papers, and stuff like that. And we have a process of clicking around all the time, um, you know, really kind of like just to see the headlines, to see what's going on, and see how like the Middle East is covering something different from Chinese state media is different than,
Yep.
wherever. Um, but yeah, I would say I spend probably a quarter of my time at least, in a week that would be relatively low, staying current on what the heck is going on.
I gotcha. And it sounds like a mix of talking to people really involved in the industry, staying up to touch with like those newsletters and stuff, and then just monitoring the news in general is kind of what keeps you current. Is that right?
Yeah, like there's a spectrum between like exploring and exploiting, right? That you kind of need to navigate when you're building a knowledge system for a firm. And like I spend probably 80% of my time exploring, trying to figure out like what direction we can orient our stuff in. Like, what are there any companies that should be in our research funnel? Are there any strategies that we should be paying attention to? Are our clients concerned about ethical things? um, you know, Spend close to no time going like, oh yeah, what's third quarter earnings going to be like, uh, or whatever.
Yeah.
But like, I will go, oh wow, that's a new book on how to value art. So interesting. Let me like get that in, because like there might be ways, there might be insights from that are applicable to how we value non-cash flowing assets in general,
Yep.
or something like that. So it's a lot less like trying to find stock tips and figure out what Bill Ackman said lately or something like that, and more like, oh, let's check in with our friends in the world of restaurant finance.
Hey, that makes a lot of sense. That makes a lot of sense. Now, you mentioned something that went a little bit over my head. I'll admit it. No, you're all good. You're all good. You were talking about the trillions of dollars on ExxonMobil's kind of balance sheet and how if we're trying to invest in an environmentally sustainable way, we have to consider that as well. Can you dive into that a little bit more? Simplify that concept.
Oh, sure. Yeah. So like, if you think about, okay, so day one, this is not a realistic scenario, but like, imagine we were to go through we were to reduce the amount of money that we were spending on fossil fuels by 50% over the next 3 years, right?
Yep.
Right. And to make it even simpler, let's say, we're not going to cut out fossil fuels entirely. We're going to cut out just oil. So natural gas, like stuff that's flowing out of wellheads anyway, cool. We're just going to keep those in the system. But things that we could actually, cut down on, distillates, whatever, gasoline, down 50% over the next 3 years. That's obviously not good if you sell gasoline, right? It's obviously not good if you sell fuel injections, or if you sell, a rear view mirror that only gets sold in a new internal combustion car,
Yep.
right? Or if you own grocery centric real estate in areas that are super dependent on cars but low income, right? So if you have an instance where fuel costs are going to go up a bunch, but folks aren't necessarily going to be able to replace it with, kind of expensive electric cars, maybe some of those kind of outlying assets will be affected as well
I
in a way
see.
that's a bit indirect. So, like, I think the one of the big things that we find, and we operate this like really litigious, some would say shrill, exclusion process, where if we come up with any reason that a company should be excluded, we put it in our naughty list, and then we just don't have to think about it again. So there's 3,000 companies on that list, each with like individual line item reasons why we put them on the naughty list. And it's the thing that's funny though, is it's never just one reason that they should be on that list.
Yeah.
There's always like, a bad governance thing and a this thing and a that thing and a whatever thing and an animal cruelty thing, that show up. And so like with a lot of this data, with a lot of this causality, I guess, I hope I'm not rambling here, but something that I find really meaningful is that there's often a character or a vibe to things that if you orient your research really carefully so that you're learning cumulatively rather than trying to sort of generate foreknowledge about like where the stock price is going to be in the next 52 months or 52 weeks, you can really start to make progress on.
That is really interesting. Tell us a bit more about some of that exclusion criteria that you guys have.
Sure.
And then specifically, let's put it in the light, because typically the next section of the show is current market insights. So kind of take that exclusion criteria and talk to the market today and what you're not looking at today, what you are looking at today.
Great. Sure. Yeah. I think I'm going to give you a much more colorific response to that than you think. The Magnificent Seven is one of the biggest exclusion criteria topics, I think, right now for us. We don't invest in them at all. We don't own a single one of them. And in part, that's because, we just feel like you could do that somewhere else. But also, they don't have the greatest relationship with humanity. Typically, like, I'm not going to go into why Facebook is a bad company. You can Google that, or why, necessarily building these giant server farms is the greatest thing ever. But there are other things that we can do. And so, like, when people think about the exclusions, like, usually what happens, one of the big kind of intellectual ideas is that I, as a stock picker, have a universe of opportunities. And by imposing exclusions on that, we constrain the opportunity set, which constrains the expected return of anything I do, right? So just because there are fewer things whizzing around for me to choose from, my returns are likely to be lower. There's something to that. If you take a naive application of an ethical criteria and just say, like, all right, here's S&P 500, we're going to take everything that has for-profit prisons in it and bad governance out of it, right? And we're just going to leave the rest of this stuff. That doesn't really jive with why indexes were built, right? The idea of an index is like, all these companies are roughly equally good. Let's just own them in proportion to how much they're worth. Right? And if you go and say you get rid of all these companies are roughly equally good as a concept, you all of a sudden can't use that same, all right, I'm just going to rank them by how much they're worth, because you've said, all right, there's other stuff that's valuable and we can't express it, cleanly.
Yeah.
So that sort of forces you, if you want to create value, and I think, any fiduciary kind of has to be like, all right, well, I'm not going to just wander blindly into a bunch of, things just because they happen to not be evil for a reason that I've identified.
Yeah.
Right. So that sort of, implies and necessitates that you're doing active portfolio management, active portfolio construction. That's the first thing people miss about exclusions, right? Exclusions means active management. The second thing is that, like, it's pointless to try and use someone else's set of exclusions because they get shopped, like they get appealed in ways that you would almost never guess. For instance, the entire state of Israel is exempt from human rights exclusion criteria in Sustainalytics and Morningstar, which is what goes into most mutual fund sustainability rankings. So, like, I'm not even, I'm bringing up just a chill, nice issue, Israel-Palestine conflict, but it is something people think about. And if you are the kind of person who has clients who might be interested in that, you're likely to find that unless you've actually done your ethical exclusion work, unless you're using intermediaries, asset managers that have a point of view on it, you're not even going to be able to get an answer to the question.
Yeah.
And so, like, I think that's, such a huge deal. And then number 3 is just like, unless you have a consistent set of exclusions, you cannot generate value as a stock picker, right? If I'm sitting here and it's like, oh yeah, this week oil companies are cool, this week they're not, this week midstream is okay, but downstream isn't. This, like, I mean, come on.
Yeah.
This week it's one drop of coal. This week it can be 35% coal. You need to have consistent policies that your clients can understand, and have them be able to go, okay, this is the point of view that my person is coming from, because like otherwise, what the heck is going on? Like, there's how are you supposed to think that I'm as credible in one moral universe as I am in another? It's absurd, but only
Yeah.
a finance person would just totally gloss over that.
I gotcha. And so you really have your criteria to the point where it's consistent now, I assume, because I'm assuming you're not a hypocrite. But given that,
Oh no, I am totally full of it. But yeah, we don't like go to the we do have just one set of ethical exclusions.
so with that one set of ethical exclusions, was it like a sit down one day and you determined all of them, and that was it going forward? Has it been developed over time? Talk to us a bit about that.
So one of the big frames that I would implore everyone to use is this frame of iteration, where I sort of went, okay, well, we have to have a line, we have a spreadsheet, we're never going to be perfect, but anytime I learn something, I'm going to put it in this spreadsheet. Right. So it's kind of a discipline of like closing out any analysis that I do, right? Like whenever I'm looking at whenever I'm thinking about something and I can associate a ticker with it in my head, I go into my research universe and I put in a little note next to the ticker, and I update this weighting that I have, which has kind of like is designed to capture vibe, basically. Not really vibe, but more like, all sorts of things. This management team seems really aligned. This thesis seems really interesting. These people seem like they're full of it.
Fair.
Mostly it's just bitchy notes that I'm taking down. But by being in that process of doing that, whether it's like a company that's in my portfolio or something that's unethical, whenever I'm learning anything, I'm flowing it into our research process. And then from there, if those things have to do with ethical exclusions, if they have to do with whatever, that's great. And then they can build on each other. But nothing is a one-off that we think of as being part of our research process. It can't be, right?
Yeah.
Like,
Yeah.
I mean, good luck with that. Oh yeah, I have derived the perfect portfolio 63-47 or 37.
Yeah. No, I gotcha. And so I'm curious, you have your exclusion criteria, and I feel like if clients are looking at the companies that you're excluding, and it's like, oh, well, this company is generating yield, but we're excluding it for these purposes. How do you account for I'm excluding these companies, but I'm still generating yield for my clients? Like, how does that kind of fit into play? And then what specific kind of aspects of the market are coming up in client conversations today?
Yeah, so I think it's a great question. Like, how do you square like a more aggressive restatement of your thing would be, you have a duty to your client first and foremost, right? They're coming to you and saying, I want yield, I want return, I want these assets to grow and deliver and be there for retirement or for whatever my objective is. But like if you're screening out things that lend to defense, the median yield of those kind of, things might be, 14-15%. If you're looking at a bunch of yield codes on solar or whatever, median yield might be 6-7-8%.
Yep.
And maybe 8% you're reaching for yield with that set of whatever's. The first thing that we do is like, we don't spend any time trying to squeeze as much yield as possible out of a pile of assets, right? Like we're not out here trying to, like if a client is trying to withdraw more than 4% of their assets in principle, or or of their assets each year, some of those assets should be somewhere else, and we should have, like a smaller chunk of them, because our focus is just on long-term, 5+ whatever years, not going away anytime soon type of assets. So a part of that we just, is being very long-term. I'm sorry, I'm sort of losing my train of thought. I'm sorry. It's been a really long day already.
Oh, you are all good. You
What was
are
I
all
talking
good.
about?
So it was basically talking about the balance of generating yield and
Oh
the
yeah.
exclusions and how it's a long-term perspective.
Yeah. So like our core thing is the this ethical growth portfolio, which we pick all the stocks ourselves. We do all the research. We can control all the ethical decisions. For some other stuff we use externally managed strategies, closed-end funds, whatever. Like if we have an impact and income strategy, for instance, where we're using a mutual fund and two closed-end funds to generate yield. Those closed-end funds are sustainable, right? They don't lend to kind of fossil fuel companies. Like basically 80% of the lending environment probably does, I would say. So if you're trying to screen that out with universal stuff, for some clients, you could wind up with problems. That said, like the clients that we're in business for see it as a problem that I can't pick each lending thing individually, right? So where they're thinking about, like, they're thinking, okay, look, Sloane has explained to me that it makes so much more sense to pick each stock individually than it does to trust some external manager, right? So they're
I
going
see.
like, do I really need this, or can it be part of my long-term investment portfolio? Which is where
Yeah.
that conversation should be, right? If you're going to be a focused asset manager, like we want to be, right, and stay focused on that core thing of delivering excellent long-term compounding.
Okay. Okay. So really, you're taking the perspective of a really long-term investor, which is probably the optimal way to invest anyway.
I mean, it's certainly a lot less effort than other ways that you can go. Like there's a lot less waking up and flexing and being like, oh my god, what is it going to go down or is it going to go up, and a lot less
Yeah.
stress, certainly.
So would you say that lends to you not being as stressed or not stressed about current market indicators because you have such the long-term view and you can prioritize your criteria and the long-term positive trajectory of it as opposed to optimizing yield in the short term?
Yeah, absolutely. Like there's this firm called Tweedy Brown, which is kind of a legendary stock picking shop, and somebody said about them in their heyday that, like, if you're walking around in Tweedy Brown, you couldn't tell if you walk around most stockbroking firms, you could tell if the market's up or the market's down. If you're walking around Tweedy Brown, you can't even tell if the market is open,
Mm,
right?
yeah.
And that very much is the vibe that I knew that I needed if I was going to have any kind of success in the investment business long term, because like I am just not good at context switching, right? So we,
Yeah.
we actually only trade once a month on the new moon. And part of the reason we do that is because it forces us to only consider actions that may precipitate trades in the context of the whole basket that they're traded against, right?
Yeah.
So we're not sitting there and overweighting some random thing that happened with a 3% position and it's taking up a whole bunch of mental space. We're running it through a consistent process where anything that came out in the last 4 weeks goes, you know what I mean?
Yeah.
And whatever it was, we think about it in the same way. So that kind of takes the onus out. Like that sort of ingrains a discipline of, all right, the stock market did a thing. Well, she's a messy so we're just going to let her do that and we'll get to it when it happens, when we get around to it.
And so do you find that clients will be hesitant to embrace that strategy? Because I feel like a market swing might stir some emotion in people and then they may want to talk about it, you know?
Yeah, no, it definitely happens. I mean, I think, when I say like, we're not trying to manage those things, I'm not saying like, oh yeah, and if you feel sad during a market swing, like take a walk. Uh,
Yeah, none of that. None of that.
yeah. Like, lose my number, lose my name. All right. But
Yeah.
like what we would do in response to that is say, okay, let's create a resource that helps our clients think about this more.
Mm.
And then, with the clients who are reaching out with specific questions, let's have a conversation about their risk tolerance,
Okay.
right? Because, to me, if a client is feeling day-to-day emotional cost from whatever the market does, that means their portfolio is misspecified, period. Right? Like, because, that's why we segregate our risk basis, like our intake, into ability and willingness to bear risk.
Yeah.
Right? Like, what we find a lot of the time is that, like, the young clients with nose rings, or whatever, who have just gone freelance and are trying to figure out what to do with their lives, who find us, go, okay, you know what, look, I don't know much about stocks, but I'm actually really able to take investment risk because I'm like, I don't need this money for 40 years.
Yeah.
And then there are clients who are like, look, if this goes down by 20%, I'm not gonna make any more money. I am retired. My husband is dead. It's hard for, like, I hear you saying that I should think 10 years down the road, but it's hard for me to even get there.
Yeah.
Like, that's a very real part of, serving clients. And, in those cases, we'll orient the portfolios more towards lending. We will complement our strategy with external managers, and we'll encourage them to have a lot in cash and take money out of the account. Like, we really want to be where their money lives when they want it to make more money. But, like, for money that they need week to week, we need to be having a conversation about what shouldn't be with us.
Yeah.
And we need to be framing that within the risk tolerance conversation, in these moments where, folks are saying, like, hey, I just, like, ugh. I know I should, and they often feel guilty when they do. Like, I've had clients express to me, like, I know I should just shut up and move on with my life, but I'm scared.
Yep.
And they know and they feel like they're annoying you,
Yeah.
and, like, we need to just be able to say, hey, your feelings are valid, your experience is valid. Let's listen to it, because if we're trying to invest this way over the numerous market cycles that are going to come, like, this is just going to happen again, and we're going to create misery in your life.
Yeah.
And it's going to tinge our every interaction with misery. So instead, let's, like, go and say, let's invest less. Let's take risk off. Let's refocus on how what we do for them is making them feel this way. And then go, like, we give them easy steps for how to change it, right? We say, like, okay, well, look, we can take less yield, expect less return, based on where you are, what you're trying to do. That will increase the statistical likelihood that you will, have to cut your standard of living at some point in the future. But it won't necessarily mean that you're doomed to do that immediately.
Yeah.
So, like, you just try to think about what it means as a functional matter, and make that clear to the client, and make sure our staff are there to make that clear to the client.
And so when you're thinking about most of your clients, or most of the capital that you want with your firm, is primarily in that accumulation phase. Like, you're like, hey, let's go long term. We're going to be accumulating over the long term. But when you have a client that wants more of the week to week, the day to day, it's first, should this capital be with us? That's the first question. Second, kind of what's your risk tolerance? And then third, if the capital is going to be with us and we understand your risk tolerance, what are you putting them in at this point to optimize for income? What does that portfolio look like?
Yeah, that's a great question. I mean, so the income portfolio will have, I mean, right now we have a global corporate bond manager that we're using that, like, I think, to have like 5, 6, 7%, whatever, in corporate bonds is not a terrible yield. We also have a couple of closed-end funds that we like, where actually, I think in all cases, or at least in the majority of the cases by asset weighting, the closed-end funds are designed to liquidate in 2033, right? So in the instance where, it's sort of stated as a short-term objective, but it's really kind of an intermediate term objective, and it'll last till wherever, you have, like, immediate liquidity and a better and better liquidity profile for this asset as we go into 2033. But closed-end funds, as you and your listeners, I'm sure, know, offer the opportunity to buy into a pool of assets at a discount to its net asset value. So you can get additional yield out of that pool without necessarily taking on additional financial leverage, right? So without necessarily increasing the level of market risk for each, kind of thing of assets. So, if you think about it like a barbell where you have that high quality corporate manager with about half of the assets, and then you have this closed end pool that's in the kind of 9, 8, 10, 11%, those complement pretty well and give you a blended rate of, kind of yield in the 7s and 8s, depending on, what's going on in the market that way. But, for clients who go, well, 8%, that's not enough yield. I would say that's almost by definition a specialist thing, almost no matter what's happening in markets, right? If you're trying to get double-digit yields, that's like a specialist manager thing.
Well, cool. Thanks for shining the light on the income side of things. Is there anything you want to talk about on the accumulation side before we move on to alts?
Yeah, I mean, like, one of the things that I think is really, I always find myself being like the ambassador for the public markets and being like, they're actually not that bad. Just because my tendency is like, to go, all right, what's the cheapest, what's the most transparent, what's the most aligned structure, where is my outcome, the simplest to estimate, where can I chop a limb off of the diligence and whatever tree. And, for public markets, in general, the vibe is, and certainly among advisors, is to move on. If they're looking for alpha there, because, most of the sustainability vehicles that are on there are kind of cursed, right? They're dreamt up by marketing, and they're like, oh yeah, the iShares aware, kind of good, not that bad, ESG, whatever fund. Really they sort of see the sizzle and the interest and the fun as happening in the alt side of the portfolio or happening in the income side of the portfolio. Like that's where you can do direct lending. That's where you can do all sorts of fun stuff. But the public markets are really very cool. So we have this long-term, equity portfolio, and we, make it available to people with as little as $1, right? So it's on the Schwab marketplace and, hopefully wherever. And we'd love to get it on to other platforms. But, really the core is 20 stocks, long-term, concentrated, and you should just own stocks. That should be how you accumulate stuff. And the way that you manage risk in a portfolio that has ethical criteria, right, where you can't index, is you just own fewer stocks. You own a set of stocks such that the risk is easier to identify, more easy to examine narratively rather than quantitatively, and just kind of easy to explain, right? Because if you are talking to a client about like, oh yeah, what's the risk of technology, like from an ethical standpoint, and you're doing it abstractly, it's really hard to not sound like you have worms in your brain.
Yeah.
But in our case, it's like, all right, so what is the risk that Duolingo? They do send threatening letters to everybody who buys something off of their internet store. That's true. Because it's kind of a meme that like, if you don't practice every day, they show up with a notification and they're like, I know where you are. I see what you're doing. Why are you not practicing Spanish?
I see.
So like, but when you're having that conversation specifically in the context of this one company, one thing much more interesting, when you're having that conversation in the context of these broad vectors, these broad whatevers, I don't know, just how can you even do that?
Doesn't work very well. I gotcha. Well, cool. We do want to jump into the alts side of things now. I know you really like the public markets.
Punk rock.
But talk to us a bit about alts, and when you're evaluating an alternative investment's potential in a portfolio, kind of what are you looking at?
Yeah, so
of course your exclusion criteria, I'm sure, still hold in the alts sector as well.
Oh yeah. No, I mean, like we wind up not doing a ton of alts business. I mean, like, so I, as a human being, am an advisor to a venture capital fund. I, am, active on the carbon removal space. I have some participations in carbon removal things, and like think, about it constantly from the standpoint of, should we be integrating this in to help our clients? Like, am I doing our clients a disservice that come to us for total portfolio construction by not thinking about this stuff? things that we have thought about include tail risk protection, kind of community loan funds. Often people will be thinking, okay, maybe I want to have, some, kind of portion of my money be lent out and able to, in order to support a certain objective, right? The first question I always have is, is the client willing to commit to the monitoring that's implied as a portion of just having any kind of private asset position, right? Like basically, if you're investing in private assets, if you're investing in hedge funds or pooled vehicles or whatever, you have to be like, all right, every quarter I'm going to think about this for the rest of your life.
That's very true.
And like some clients want that, some clients don't. And, for the clients that do, like they often demand it of you, right? But you just kind of want to check in on that first off, if they're in that posture, if they're kind of thinking about dipping a toe in, because it's a different sort of education in either case. But from like, what fits, I really like to see venture as part of the overall portfolio construction if people are doing that, especially if they have an impact lens. Real estate, I know you guys do some real estate stuff, winds up being a part where there's just so much issuance out there. There's so many real estate strategies, so many opportunities to do really interesting things. My sister is a mechanical engineer who does building projects, and I keep being like, babe, like, come on.
Yeah.
You have no idea how like much interesting stuff there is and how much opportunity there is to create local impact doing real estate investing. So like that's something that I think is a huge part. And then, depending on whether you consider direct lending through marketplaces or whatever, as an alternative or as income, I think that would also be, you can basically construct your own little mortgage REIT using like whatever, pick your favorite marketplace, and do it with direct attribution to the individual underlying credit. So like as these portfolios get more interesting and as the ability to assess data inside the investment organization and the client becomes better, like they should be thinking about, all right, well, geez, like, why are we not, just doing some of this ourselves, getting more precise about what we kind of want to be exposed to.
You mentioned what was it? It was community lending.
Yep.
Talk to me a bit more about that experience with that. Do you have any experience, or what made you bring that one out specifically?
So I'm just part of a community of folks that, are variously exploring this question of how do you invest in the solidarity economy, right? So, that being kind of building infrastructure that directly supports or funds more resilient communities, whatever. With respect to loan funds, there's a group called Seed Commons, which I have a great friend at, Leo Freeman, who's a very interesting person for your podcast to talk to. But what they do is they work with about 50 or so local organizations to administer these place-based lending funds, right? So you might have one in the Navajo Nation, you might have one in New York City. And they each have their own objectives to make capital available in various different forms. So for the right client in the right context, they might find that participation in one of those is very rewarding from both a risk diversification standpoint. It is, whatever else it is, it's a very different risk profile than you have in the public markets or you have in corporates or whatever. But it can also be rewarding from a psychic standpoint. So those community loan funds have their own, kind of things. And, we don't really do a lot of advising it. Like generally I bring it up in client conversations from this standpoint that we can refer capital out to it. Right. That would be a standpoint where we're advising against the firm's interest, because we would literally just be saying, hey, take this money elsewhere. But, we try to make sure that we would be able to do that as a firm. And so our process and our relationship to those is basically that we think it's something that is appropriate to transfer capital out of the firm to for the right client. And we want to make sure that they have an awareness of it. and that we have the confidence to honestly represent to them that it seems like a decent idea, and one that's not going to, have them coming back to us, 5 years from now, like, I love you, but man, you convinced me to buy the worst used car.
Yeah. Yeah. Well, that's awesome. I actually hadn't heard of the community lending before. That's why I kind of wanted to press into it a little bit, hear a bit more about it.
There's tons. I mean, Addisina Social Capital works for the group that does some direct, kind of lending linked to municipal bonds, right? So there's opportunities to do it within like a tax advantaged, kind of financial planning context. And then there's opportunities to do it within kind of just a more straightforward, taxable income portfolio. But yeah, I mean, like, I think when people say advisors don't understand, investment professionals don't understand the opportunity set in sustainable investing, that's what I really mean, is like, they don't understand the ways to actually generate real after-tax return for clients in this way.
Yeah.
Like, and they also don't understand like what's out there and that it exists. Because all of these firms are run by people who like drive Subarus and eat granola for breakfast. They're not like coming out of like the Morgan Stanley impact investing department. And so there's a little bit of a lag in market awareness. And, unfortunately, the kind of much more boring, much less impactful investment strategies crowd out the good stuff, as it's always been with every kind of strategy.
Yeah. Is there some sort of indicator, kind of HubSpot of like, this is the level of impact this investment is creating, to like actually tangibly see the impact?
Such a good question. Like, how do you get your hands around what it is that's happening?
Yeah.
Right. Because like, I think as investment professionals, we kind of want this to be something that looks like an accounting entry, right? Like, we got the income statement, the balance sheet, cash flow statement, and the impact statement. It's all the same stuff. Fact of the matter is, it's just not ever going to happen that way, right? And it's a great act of intellectual dishonesty, I think, on the part of MSCI and various ESG data providers to kind of try to make it seem like you can assess impact in the same way that you can assess creditworthiness, right? So the way that we think about it is we go, okay, everything in our portfolio, in our ethical growth portfolio, not only needs to be something that avoids preventable harm to living things, which is our firm's number one. That's what veganism is: avoid preventable harms to living things. And we invest vegan because we invest in ways that avoid preventable harm to living things. But then also beyond that, it needs to generate positive impact the same way it generates revenue. So if it's a lender, the top revenue line needs to produce positive impact in the world that I can understand. So part of it is we just help our clients understand that in a qualitative sense. Like, we go, hey, they did 28 billion in revenue. And that means that they basically made, 54 or whatever it is $billion available to rural America. 50, like that. And so like, you sort of break it into those bullets, and then you say, okay, it seems like everybody's talking about how their local business magazine named them the greatest place to work or something like that. Right.
Yeah.
So you kind of track those things. And you find ways to go like, oh, okay, so, if you're trying to think about us in this context, here's what's happening. So, you'd say 13 of 18 of these companies have been named a best place to work in their local business magazine. And of course, everything falls under our big exclusion list, right? All the logic that we've talked about throughout this whole onboarding, this whole conversation. But by going and saying, all right, here's this, here's that, here's the other thing, it allows the client space to ask about the things, the subcomponents of whatever that are most important to them, right?
Yeah.
So they can say, what about plastic use? What about water use? What about this, that? And we can say like, oh yeah, well, we do have ASML which is a giant. It's the company that makes the UV equipment that makes all chips, right? So no chips without ASML anywhere basically. So we can say, oh yeah, we have this participation. That is the technology that needs to get better so that the chip making process becomes more water efficient. We do have the ability to exclude it from your portfolio, but we think that you shouldn't, and you should just kind of keep it that way.
Yeah.
And if you disagree, you should tell us. And that winds up kind of creating research help from us out of our community, right? So it takes their nerves or whatever and puts them into a productive place that we actually tangibly benefit from almost every time we do a rebalance.
I love that. I love that piece of communication. And you mentioned the word community there. And the one thing I do want to get into before we kind of wind down the show here is the important aspects of the client advisor relationship from your perspective. What do you think is really essential to making that relationship work?
Yeah. Yeah. I mean, trust, and trust, also trust. It's just, I think so in so many cases, where we are as a profession is that the word advisor means nothing. And to advisors who are well placed to help their clients over the long term, that's infuriating. Because I became an advisor at 19, shortly after passing an absurd test that asked me about like how many days after you issue a trade does it settle. It's like, all right, cool. All right. So you want to be a barber? Great. What's a scissor and what's a spoon?
Yep.
I think part of it is just to set this understanding that like your clients will have heard all kinds of things coming into you. They're not going to feel safe with advisors. They're not going to feel like they're going to get listened to. And it's important to us to just meet them where they are. Mirror their level of anxiety, right? So if they, think that they need to get this deposited in this second, and if they don't, they're going to forget about it and their financial life is going to be terrible and they're never going to retire and they're going to be eating cat food 50 years from now. And, all of that stuff.
The rabbit hole.
Yeah. Because this is like investments they touch everything. They are this, substrate of any future goal, any whatever. And so we try and go, all right, if they come in and they're at that level of anxiety with us, we want to be back to them shortly. We want to be like, setting everything up perfectly, responding, communicating on it proactively and whatnot. If they're like, hey, what's up? I sort of never really thought I'd have any money. And it turns out, to my shock and horror, that I've got $10,000. What do you think I should do with it? We take a kind of a different approach that's a little chiller and, where we're not necessarily going, and explaining about settlement and clearing and all these details, and like why their money will be available on Thursday and not Friday. We just sort of skip that stuff. So like understanding the resolution that the client wants to communicate at is, I think, a really important part of just doing that well. And that's, I think, a big part of fiduciary duty, right? Because if your client doesn't understand, they can't consent. And if they can't consent, nothing you're doing is consistent with a fiduciary relationship.
Yeah.
I
love that. Specifically the A, building it on trust, and then B, tailoring the interaction to what they want. It's just like a classic principle of just how to interact with other people that can often be overlooked,
Are you saying that we in the finance industry tend to not necessarily think about the humans behind the dollar signs? I'm sure we wouldn't assume. I'm sure there couldn't be like tons of academic and practical evidence for exactly that.
Yep, absolutely. Well, cool. Last question for you here on the show. Tell us about we've talked a little bit about your firm. We've talked about the exclusion criteria that you have from a high level perspective. But if you had to say one thing that really sets you guys apart from other firms, what would that be?
It's a good question. Where we're coming from is, I think, the biggest thing. I mean, we are not for everyone, and we are not going to change that. And like, I think if you sort of go, how are the vegans going to react in response to this? You get a couple of ideas pretty fast, even if you don't know that much about veganism, right?
Yeah.
And so I think that is really a big part of how we've been able to get it. Like literally, our close rate on conversations is in the 90s%. Right. It's like when someone comes in, sits down, talks to us, the odds that they eventually open an account are excellent.
Yeah.
Not really, clear when they'll get around to it. Like it might be 6 months or whatever. But very, very infrequently do we have a thing where somebody comes in and then walks away and is like, oh, I don't know. I don't know. This doesn't seem like it would be reassuring at all. Because what happens is those conversations go with them, and they, when they're thinking about investing in the future, and they're like, how would I do this ethically? They can go and put it immediately through a lens of how would we think about it, and they realize that it would be comforting to have somebody who's thinking that way. So that I think is kind of our special sauce, that people kind of sign up for them going, well, how would Sloane think about that? And whatever she does is hopefully cool, that's our special sauce.
Well, Sloane, thanks so much for coming on the show. And where should people go to find out more about you?
Oh yeah, thank you. It's been just phenomenal. You're a wonderful interviewer, and I'm looking forward to kind of dialing in more. To find more about the firm, investvegan.org. I also host a podcast, Free Money Podcast, with Sloane and Ashby. You can find it either on freemoneypodcast.com, which has all the back episodes, and we have an AI that we've been having some fun training to do data scraping and whatnot. But and then that's also in your podcast store of choice, right? So if you just type in Sloane Ashby, two weird names, and then free money, kind of rememberable concept. That's really kind of where, that was actually, that podcast was going to be a PhD, and then it turned into a podcast. So we wind up exploring all sorts of random stuff, and that's probably the best place to get long form downloads from me.
Amazing. Well, if you guys are listening and you loved what Sloane had to say, all of that will be down in the show notes. Thank you guys for watching, and we will see you on the next one.